In February 2026, the Iran war broke out, and the Strait of Hormuz, the primary artery for Middle Eastern energy exports, was closed to maritime trade. This choke point isolated hundreds of oil and product tankers inside the Persian Gulf, severing them from the global market. With no export routes available and storage facilities hitting maximum capacity, regional producers were forced to shut in their oil wells amidst the military conflict. The immediate result was the removal of nearly 20% of global oil supplies from the market. By volume, this constitutes the largest geopolitical oil supply disruption on record. In this environment, volatility transitions from a measurable risk into a structural break. Historical correlation data, typically built on minor proportional fluctuations, cannot account for the total cessation of trade along a major global route. Faced with this disruption, central bankers required exact estimates of how this specific supply shock would increase domestic PCE inflation. To answer this, researchers at the Dallas Fed had to address a severe modeling limitation. Standard macroeconomic models are linearized. They rely on the assumption that market reactions to shocks are proportional and symmetrical. They are not designed to compute the extreme downside risks associated with rare, large-scale disasters. Attempting to build an all-in-one, multi-country model that accounts for complex nominal frictions across the globe is computationally massive. In a fast-moving crisis, that structure is too brittle to be useful. The researchers created a decoupled two-step pipeline, explicitly separating the chaotic global oil market from the rigid tracking of U.S. domestic inflation. First, a nonlinear global model generates potential oil price trajectories. These are fed directly into a localized structural VAR model. By structurally isolating the global chaos from the domestic econometrics, this pipeline generates rigorous domestic inflation projections in real time, bypassing the computational heavy lifting required by more integrated models. The first component of this system is the nonlinear dynamic stochastic general equilibrium model, or DSGE. Instead of relying on guesswork, this model determines the price of oil endogenously. It calculates the price based strictly on global supply, demand, and agent expectations regarding the length of the supply outage. The core modeling choice is Epstein-Zinn preferences. This accurately represents the behavior of hyper-risk-averse agents reacting to severe geopolitical downside risks. The model simulates probabilities of the strait remaining closed for 1, 2, or 3 quarters. A 1-quarter closure spikes the WTI price to $103, dropping to $71. A 3-quarter closure compounds the pressure, climbing to $132 and peaking at an extreme $167. This divergence demonstrates that the relationship between the duration of the outage and the price of oil is intensely nonlinear. The DSGS must map these specific trajectories before any domestic inflation analysis can begin. Moving from the global model to the domestic model introduces a temporal mismatch. The DSGS operates on quarterly global averages, but the domestic structural VAR requires high-frequency monthly data to measure inflation accurately. To bridge this gap, researchers mapped the DSGS first quarter strictly to the calendar months of March, April, and May of 2026, aligning the event with the real-time calendar. Next, they had to translate the price of raw crude into the retail cost consumers actually pay. They did this by applying the historical cost share of crude oil to the retail price of gasoline. Using recent data, they locked in a fixed 0.5 cost share weight. This dictates that retail gasoline prices absorb exactly half the percentage volatility of the WTI crude oil price. This mathematical translation provides a clean, month-by-month vector of retail gasoline price growth. The data is now perfectly formatted for the domestic SVAR model to consume. This brings us to the second half of the pipeline, a monthly structural vector autoregression, or SVAR model. The state vector in this model tracks 5 specific variables: gasoline price growth, headline PCE inflation, core PCE inflation, 1-year household inflation expectations, and 5 to 10-year inflation expectations. The primary econometric challenge here is identification. The model must isolate the exact effect of gasoline prices driving inflation while filtering out macroeconomic feedback. Researchers use a structural impact multiplier matrix. Within this 5x5 grid, the top row contains 4 strict zeros. These zeros lock in the assumption that retail gasoline prices are predetermined. shocks force the model downwards, but domestic metrics cannot force gasoline prices upwards simultaneously. This assumption holds because a massive global geopolitical shock shifts the price at the pump instantly. Macroeconomic indicators like core inflation lag behind by weeks or even months. This rigid mathematical restriction completely isolates the structural gasoline price shock. It ensures the model is measuring pure geopolitical impact, free from domestic feedback noise. With the structure locked, the researchers execute the simulation using a structural moving average decomposition. The algorithm works recursively backward through the data. It calculates the precise magnitude of the domestic gasoline price shock required in each month to match the quarterly target paths established by the global DSGE model. For a one-quarter closure, headline PCE inflation spikes to an annualized 5.2% in March, but decays towards zero by summer. If the strait remains closed for 3 quarters, inflation stays elevated, resulting in a 1.47 percentage point increase for the 4th quarter. But headline numbers include highly volatile components. To understand the deeper economic damage, we have to isolate core PCE, which strips out food and energy costs entirely. If the closure lasts only 1 quarter, the pass-through effect on core inflation is just 0.18 percentage points by the end of the year. That is a negligible shift, practically registering as statistical noise. If the closure stretches to 3 quarters, core PCE sustains a 0.49 percentage point increase by quarter 4. This means the external energy shock has now directly bled into the prices of everyday goods and services. Extended outages shift the inflationary burden into the structural components of core inflation. This creates a persistent price level that outlasts the initial energy spike and changes the overall trajectory of core domestic prices. When core inflation rises during an energy shock, central bankers fear one outcome above all else: that consumer inflation expectations will become unanchored, triggering a self-sustaining wage price spiral. This chart shows consumer outlook projections. Under the stress and the 3-quarter outage, 1-year expectations rise by only 0.61 percentage points before decaying. Moving to the 5 to 10-year horizon, the trend line tells a more important story. It is effectively flat. Across modeled scenarios, the absolute maximum increase in long-run expectations is a negligible 0.09 percentage points. The data confirms that long-term consumer expectations remain firmly anchored. Because of this stability, the United States economy can absorb a severe short-term global energy shock without triggering an uncontrollable wage price spiral. During severe disruptions, central bankers cannot afford to base monetary policy on guesswork, nor can they rely on rigid models that struggle to incorporate extreme variables. By explicitly dividing their architecture, the researchers found a way to connect the chaotic, nonlinear realities of global geopolitics directly into the rigorous, high-frequency precision of domestic econometrics. This system is designed for scalability, functioning as a framework to quantify massive exogenous supply shocks by isolating global oil market risk directly from domestic price transmission. By separating global nonlinearities from domestic linear transmission, economists have engineered a mechanism to extract actionable policy data directly from the fog of war.